Hello, and welcome to Chapter 5 Merchandising Businesses. In this chapter, we're going to focus on a retail business that buys inventory and sells inventory. We're going to see how their accounting is different from a service business, which was the focus of our first 4 chapters. So let me get started with sharing the PowerPoint slide. And you will see I've written over here part 1. These slides have been modified. I'm going to break the chapter up into 3 parts for the purposes of making videos so that they aren't too long. The first part we're going to focus on perpetual inventory, and we'll get to that in a second. So let's first focus on the flow of cost. As I said, in the first 4 chapters, we had looked at a service business. This chapter onwards, we're going to be looking at merchandising businesses, and we're going to see what's different between the two. But there's also something common, lots of things common between these types of businesses. Both of them start in their income statement with sales revenue, and both are going to end with net income. That's the purpose of the income statement, to record your revenues, expenses, and income. For the service business, all they had was revenues and expenses, and the expenses for the most part all we focused on were the operating expenses. So revenues minus expenses gives you the net income. For the merchandising business, they have the revenues, the last line is the net income, and they haven't gotten rid of operating expenses. They have the same operating expenses or very similar to what a service business has. They have an additional cost. That additional cost relates to the inventory. They buy inventory, they sell inventory. So there is a cost associated with generating revenues, and that's the cost of goods sold. And that's where our focus is on this chapter. So sales revenue less cost of goods sold gives you gross profit. That's just an in-between number, an intermediate number that we want to see how profitable we are with sales that we make. We then subtract all our operating expenses to arrive at the net income. Now, in terms of recording this cost of goods sold or arriving at the cost of goods sold number, a company has one of 2 ways in which they can maintain their books: the perpetual inventory system or the periodic inventory system. And as the name suggests, the words, perpetual means continuous, periodic means it's done only periodically. So what we're looking at is how often do we update our books, do the journal entries that affect cost of goods sold in the perpetual versus the periodic. Again, within this video, we're going to focus on perpetual inventory system. So let's take a look at what we have over here. Now, I'd already mentioned the cost of the inventory. That's what I paid for the inventory. Usually, most firms have a second cost, which is rather big, and that's the freight charges. Someone has got to pay to have the goods delivered from the manufacturer or the wholesaler to the retailer. So the manufacturer, the wholesaler, they are the sellers. The retailer is the buyer. They are the ones buying the inventory before they can sell it. They have to pay for the freight to have the items delivered to them. Someone has to pay for it. Either the seller pays for it or the buyer pays for it. So how do we find out who pays for it? It depends on the terms used in the contract. So if it is FOB, which means free on board shipping point, the seller gives the goods to the public carrier. Let's say it's UPS. UPS gives it to the buyer. As soon as the seller gives it to the UPS public carrier, the ownership passes to the buyer. During transit, which means it's not yet reached the buyer, they're already the owner of the goods. That's why they pay for the freight. So here what you see is ownership of the goods passes to the buyer when the public carrier accepts the goods from the seller. So the minute the UPS guy takes the goods, the seller is no longer the owner. They're not responsible for the goods anymore. Buyer is the owner, therefore they have to pay for the freight costs. Now there could be another type of freight terms, and that's called free on board destination. Free on board destination means the title of the goods, which means legal ownership, passes only when the UPS guy gives it to the buyer. So who's owner during transit? The seller is still the owner, therefore they pay for the freight costs. So ownership of the goods remains with the seller until the goods reach the buyer, until this point. So for our purposes in this chapter and subsequent chapters, always look to see Are the terms free on board shipping point or are they free on board destination? Free on board shipping point, buyer pays. Free on board destination, the seller pays. If the buyer is paying for the freight cost, it adds to the cost of the inventory. What happens if the seller pays it? It's a selling expense. It's separate. Okay, it's not a part of the inventory. You're going to put it into the selling expense account, which is a part of your operating expenses. Okay, so to continue with, let's see how we're going to pull out numbers and where we're going to get those numbers from. So in the perpetual system, you're going to maintain detailed records. Every time there's a purchase or a sale, you continuously show your inventory. Your inventory records will continuously show you what you have on hand. Companies can determine the cost of goods sold each time a sale occurs, and we'll see that in a few minutes how that is done. So now let's look at where these numbers are actually going to come from. So we're going to work through an example where we have PW Audio Supply Company, that's a seller. This is what they call a sales invoice. This is their invoice, that's why their name is there up on the header. They are identifying who it is sold to. So this party is a seller, this party is a buyer. For our journal entry, important piece of information that we get from the source document, the date of the transaction, the terms, these are the credit terms, we'll go over that in a minute. The freight terms, it's free on board shipping point, and the total cost, this is the amount, dollar amount that's going to go into the journal entry. So these are all important pieces of information that we get from here. Anytime there is a sale, it could be a cash transaction or a credit transaction. In this case, it's a credit transaction because terms, if it was cash, they would say cash. When they give you terms along these lines, it means it's a credit transaction, which means money will be paid later on. Normally you record, which means a journal entry is done only when the goods are received from the seller. So when I buy goods, when I place the order, I don't do a journal entry. Only when I get the goods, that's when I do my journal entry. A purchase invoice has to be there. That's a document that I rely on to know that it's a credit purchase. So I need to see this document. Now, this looks like a hard copy of a document. In reality, these days, no one gives you a hard copy. It's all electronic, but it's the same. The format is the same. The information is the same. So it doesn't matter in what form you have it, but you need this document. Your journal entry is based on this source document. So what's my journal entry? On this date, May 4th, date of the invoice, the buyer will write inventory debit, 3,800, accounts payable credit, 3,800. If it was a cash transaction, they'd credit cash 3,800. So inventory is debited 3,800. So with this journal entry in my books, I know my inventory, that's $3,800 is the amount of the value of my inventory. Now let's continue. We're going to look at the credit terms. Credit terms permit buyers to claim a cash discount for prompt payment. Now, anytime you get a bill and you have 30 days to make the payment, most of us are going to wait the 30 days to make the payment. The seller runs a risk. The risk is I may not pay at the 30 days, I may forget to pay, all kinds of things could happen. As far as they're concerned, they gave up their inventory, they're still waiting for their cash. So they throw in a small incentive. That incentive is what we're talking about over here. So what's the advantage of offering the incentive? For the buyer, they save money. I'm going to get a little discount off the invoice price. That's good for me. For the seller, they get their money sooner. They don't have that anxiety of waiting 30 days. So as in this example, the terms are 210 net 30. What do each of these numbers mean? A 2% discount is allowed, which means the buyer will get a 2% discount if they pay within the next 10 days. Otherwise, they have the full amount that they have to pay within 30 days. So now the question really is, how do you read this 10 days? Whatever is the date of the invoice, start counting the day after. So in this case, May 4th is the date of the invoice. We start counting from May 5th. May 5th is day 1. May 6th is day 2. May 7th is day 3, so on and so forth. Okay? So that's how you would count, and you have 10 days. If you pay within that 10-day period, you get the 2% discount. Otherwise, you have to pay the full amount. Okay, so let's look at these journal entries and see how we would lay this out. May 4th, there was a purchase of $3,800. We already saw that journal entry. It was inventory debit, accounts payable credit. The terms are 210 net 30. May 5th, we received a bill for $200. It is due end of month, and this is a freight bill. These discounts we've talked about over here never apply to the freight bill. This discount is offered by the seller on the invoice price of whatever they're selling. Typically, we'll never have a discount on the freight bill. On May 8th, merchandise worth $300 was returned. The buyer sends it back to the seller. So how much do they owe? 3,800 minus 300 is 3,500 is what they owe. So let's say if the payment is made within the discount period. Discount period is May 5th through May 14th. Let's say on the last day of the discount period, May 14th, they make the payment. Their journal entry is going to be accounts payable debit, 3,500. That's what they owed. They're going to get a 2% discount off the 3,500. So the cash they're going to pay is $3,430. The $70 discount they got, they credit inventory because the inventory is that much less expensive. Okay, so it's not that they're giving up their inventory, it's just that the inventory has become less expensive. What happens if they pay after May 14th? They pay the next day on May 15th. How much do they have to pay? The full amount, $3,500. Accounts payable debit, cash credit. So they have all the way through June 3rd. Count 30 days. Okay, May 5th through June 3rd, that's a full 30 days. So May 15th through June 3rd, they have to pay the full amount. So if I was going to make the payment, makes no sense making the payment on the 15th. If I had paid it 1 day sooner, I'd have saved $70. Okay, so now the next thing we're going to look at is merchandise that's returned, how we handle that. So this dealt with the discount. So now let's look at merchandise, purchase, return, and allowances. This is when merchandise is returned. Anytime you buy merchandise, unless you're told specifically that it's a final sale, which means you can't return it, you have the right to return the goods. There could be certain terms and conditions. You have to return within 10 days, 20 days, 30 days. You have to bring the receipt. It has to be in the original box, whatever the case may be. Why would a buyer return the goods? They would return the goods. Now we are talking of the retailer being the buyer. Why would the retailer return the goods to the manufacturer or the wholesaler? In most cases, because the item was damaged. It was not to the specification that they had said. Let's say I wanted to purchase pink handbags and they sent me blue handbags, a completely different color, or even if it's a different shade of pink that I had asked for. I have the right to return it because they didn't give me what I asked for. If they give me wrong quantities, if they send me something after the date, I tell you that I want it by date and I specify the date, and you give it to me after that date, I don't want it, I'm going to return it to you. So we'll see what happens when there is a return and what this word allowance means over here. So in a purchase return, the customer physically returns the goods for credit if the sale was made on credit, or for a cash refund if it was a cash transaction. So here the customer is the retailer. They are physically returning the goods, and we said it was $300 of return. So the journal entry would be accounts payable debit 300, inventory credit 300. The reason I'm debiting accounts payable is I no longer owe the amount. I've returned it. And inventory credit, because that inventory is not with me. I'm taking it off my books. Now, in some cases, the seller is going to try and negotiate with the buyer and say, please don't return the goods, keep it. No seller wants goods back once they sell it. So if they don't want the goods back, what can they do? What can they possibly do? Okay, what they can possibly do is offer a cash discount and say, a cash incentive, sorry, we don't use the word discount. I offer a cash incentive. Now, what kind of cash incentive can I offer? I decrease the invoice price. So the customer keeps the merchandise if the seller will grant a reduction in the purchase price. So what's a journal entry? in the books of the buyer. Do they owe that $300? No. So accounts payable is going to be debited $300. And to that extent, that inventory has become $300 less expensive. So in both cases, the cost of the inventory has gone down. The difference in these two situations is, in this situation, the inventory physically has decreased. Here, the inventory physically has not decreased. Okay? We combine these two types of returns and call it purchase return and allowance. It's just combined into one account. But internally, if you ask the accountant or the bookkeeper who is doing the system, they can give you details about this particular, the breakdown about the inventory. Okay. With that, let's move on and now look at the seller. The seller has the invoice. That's the same invoice that they created. They're going to create journal entries based off this invoice. Now, the sale may be for cash or credit, just like the purchase. Sales revenue, like service revenue, is recorded when performance obligation is satisfied. Just as we said that the buyer is not going to do a journal entry until they get the invoice. They get the invoice only when they receive the goods. The seller is not going to do a journal entry until they actually deliver the goods. Same thing. Performance obligation is satisfied when the goods are transferred from the seller to the buyer. That's in a merchandising business. And the sales invoice should be there to support each credit sale. Just as we had said for the buyer, the purchase invoice is required to purchase to support a purchase transaction, that is a credit transaction. Same thing over here. So all the terms and conditions we talked about still stays the same in this example that we are looking at. Okay. So the seller sold $3,800 worth of merchandise on May 4th. Their cost was $2,400. So on May 4th, they're going to do two journal entries. The first one is accounts receivable debit, $3,800. Sales revenue credit, $3,800. This journal entry is made at our selling price. I'm the seller. So accounts receivable debit, sales credit, $3,800. That was the sales invoice. What was my cost? What had I bought it at? $2,400. So I'll do a second journal entry. The second journal entry, I'm saying, in order to make the sale, I had incurred a cost. The cost of these goods sold, that's literally that word. Cost of goods sold is cost of these goods sold is $2,400. And inventory credit, because that's no longer with me now. It's gone off my, physically gone away from me. Therefore, I should take it off my books. Inventory credit. This is always at cost. The difference between these two numbers, sales revenue minus cost of goods sold, gives you the gross profit. So for this transaction, the profit is $1,400. 38 minus 24 is 1,400. That's the profit, gross profit on this particular transaction. Okay, now let's look at sales return and allowances. Whatever was purchase return and allowance for the buyer becomes sales return and allowance for the seller. This is the flip side. Unlike what the buyer does, makes an adjustment to inventory account, we're going to keep this separate over here. We don't want to debit sales revenue. We're going to have a contra revenue account. We don't want to reduce the sales amount. We don't want to debit it because that would obscure importance of sales return allowance as a percentage of sales, and it could distort comparisons. So let me give you a really quick example of two firms. These are two retailers, and they're kind of extreme in this particular philosophy and the merchandise they carry. Walmart and Neiman Marcus. Walmart as a company just accepts the fact that a good 10% of the merchandise they sell is going to get returned. Customer purchased it, they didn't want it, they weren't happy with it, whatever the case may be. They just accept that. The alternative would be to have more sales associates on the floor, and Walmart has decided it's not worth it. Neiman Marcus, on the other hand, they pride themselves that anyone who purchases a product from Neiman Marcus, typically you're looking at clothes, will never return those clothes. That's because there's a sales associate that works with you and you, the buyer, and helps you buy that particular item. So these two companies want to know what their returns are. They want to know. So for Walmart, if it goes about 10%, they're going to be concerned. For Neiman Marcus, if it comes to even 1%, they're concerned. All their sales staff are purely on commission basis. So those people are not going to get commissions, or the commission is going to get deducted if something comes back. And it's a huge stain for a Neiman Marcus sales associate if there's a return. So they pride themselves for that. So this is really important to know what the sales figure is and what the returns and allowances are. So let's take the same example. $300 worth of merchandise is returned. Now there are going to be two journal entries. The first journal entry, let's look at that. Sales return and allowance debit and accounts receivable credit, $300. This was the merchandise that was returned. Remember the journal entry the other party had done, accounts payable debit, inventory credit, saying it's not theirs, they gave it back to the seller. Now the seller has to make a recognition of the fact that what they thought was sales is not sales anymore. They debit the contra account, sales return and allowance. On the same day, they have to bring the inventory back into their books. So the journal entry that they had done when they made the sale, cost of goods sold debit, inventory credit, they flipped that journal entry for the cost of the inventory, whatever the cost of the inventory was that they had sold. In this case, they're telling you it's $140, and they're telling you the inventory is not defective. When it comes back, they can sell it again. So it's $140 over here. What if this inventory was defective? Will it change the first journal entry? I won't change the first journal entry. That stays the same. The second journal entry is going to be different. So let's take a look at that. The inventory is returned. It has a scrap value of 50, which means that's the best I can sell it for. So sales return and allowance debit, 300. Accounts receivable credit, 300. That stays the same. The second journal entry, the account names that are debited and credited stay the same, but the dollar amount is different. I bring it into my books back only at 50 because that's what that inventory is worth. So we've looked at buying inventory from the buyer's viewpoint, purchases, purchase discounts, and purchase return and allowance. From the seller's viewpoint, we looked at the sales, we looked at sales return and allowance, and now let's take a look at the last step, that's a sales discount. They're going to get paid. So $3,800 was the original sales invoice number. $300 return, which means the buyer owes the seller $3,500. Now let's take a look at the amount that is going to be paid. Okay, May 14th, the buyer pays the seller the amount due. $3,800 minus $3,000 is $3,500. It's within the discount period. Now they paid the full amount that's owed, $3,500. Okay, the amount, they're not paying the dollar amount, but the account is settled in full. The sales discount is $70. The exact same way as the other party calculated, it's going to be the same over here. And for this party, it's cash debit. For the other party, it was cash credit. For this party, it's cash debit. So this gives you an overview of the perpetual inventory system. In the next video, you're going to see the periodic inventory system. So the last slide I have for you over here is the net sales figure. If you recall, in this first slide, I had showed you the income statement for the merchandising business, sales less cost of goods sold, you give you gross profit. The sales report number that's reported is a net sales number, which is the gross sales, less sales return allowance, less sales discount. So 3,800 minus 300 minus 70, 3,430 is a net sales number. That's a number that's reported in the income statement. So with this, we conclude this particular video, and I look forward to talking to you again in the next video.